Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. We're going to rip through Twitter, see what people are sharing on social media. I generally do this to see what others are talking about or charting. It's always best to look at other people's work, not just my own. Sometimes they see sectors breaking out that I don't, when I'm scanning through it, and sometimes they see maybe patterns on different time frames than I do. So that's why I go through this all the time. It gives you another kind of angle on the commodity bull market and other sectors of the market. I basically share everything that's financial related. So let's go through here. Let's see what people are talking about, generally related to three different topics: commodities, financial topics, and or wealth building. Those are the three important ones that I think are highly important in my life, and that's kind of what I track and follow. So let's dive in here. Let's see what's going on in the overall markets and what people's opinions are. If you want to follow me at Finance, and if you want to join our community, find-value.com, we still have a discount going on, LEAP, LEAP, and you can join for the question and answer session we've got coming up and the midweek update that I'm releasing tomorrow. Or today, I should say, because this is going to be released on Wednesday. So Rothmus, libertarians diligently plotting. It says Biden wants to spend 7.3 trillion in 2025. This is about $45,600 per taxpayer. Ask yourself this: do you see $45,600 per year in value from the federal government? I can't even find the words to explain how insane this is. And this is really insane. $45,600 per taxpayer? That is crazy in a single year. This is not going to be paid back, guys. This is going to be highly inflationary. I mean, this just doesn't make any sense to me. When I read this, I was like, man, $45,600 per year? Ridiculous. And I'm sure there's some revenue that they're going to get, but even so, this is absolutely ridiculous. This is also ridiculous. Magnificent Seven stocks are undervalued relative to the rest of the stock market, says JP Morgan. What? The Magnificent Seven stocks are actually undervalued versus the rest of the market, JP Morgan says. Now, maybe if there's some really crappy stocks that you're comparing against, maybe that's the case. And maybe it's all relative in the same sectors, but I don't think that they're relatively undervalued in relationship to half of these, we'll call it like drilling companies and shipping companies, where they're priced at literally 1 to 2 to 3 times cash flow. That is just an absolute steal. These guys, they're priced way up there in relationship to cash flow, or price to sales even. They're like 20 times price to sale on some of these, maybe not the Magnificent Seven, but some of these stocks. Well, Nvidia is probably way up there. I don't know the exact amount this second, but it's price to sales is way up there. Last time I checked. Central bank demand matters a lot more than ETF flows for gold. And this is the central bank demand we know about. So central banks buying gold while investors sell it. This is the total known ETF gold holdings. And this is the central bank gold holdings as it's basically breaking out to the upside. So central banks are basically stockpiling gold while the ETF unloads it. And maybe that's, you know, maybe this is the flow of gold from the west to the east. And remember, the custodians of a lot of these ETFs are JP Morgan. And the way that you keep the price down is you're going to have to unload your ETF holdings, gold holdings, and you're going to have to sell it into that strength to hold the price down if other central banks in the world are buying. The only way they can do it, if they try to do it. Gold versus GDX since March 1st, 7% rally in gold pushed GDX twice as much, up about 14%. While 2x would have been considered a healthy relationship in normal circumstances, it is not given a multi-year lag in miners. As gold consolidates under $2,200 level, I would like GDX to add another 7% to make the relationship between gold and GDX a 3x. What I look at is I look at how cheap GDX and or XAU is in relationship to gold. That valuation mismatch did not exist in the 2000s bull market. We have not been this cheap for I don't know how long, since at least the 1990s. I don't know if we were this cheap in the 70s either. Gold miners in relationship to gold itself is what I'm referring to. So I see this as one of the biggest opportunities. I mean, if you yank up a gold chart, we're making new all-time highs. You yank up a silver chart and it's got a 50-year cup and handle pattern. If we break and engage the 50-year cup and handle pattern on silver, I would expect gold and silver mining companies to go ballistic at some point if we start moving to the upside. Money's going to rotate over, and it could be the beginning of a monster run. What's going to cause that run is what a lot of people ask. In my opinion, it's going to be oil. It's going to be the shortage of energy. 1970 was the start of the gold bull market, which was also peak oil in the United States. In the 2000s, we were hitting oil constraints, and people were suggesting that we were hitting peak oil of conventional oil for the world. At the same time, we had credit growth in the 1970s and in the mid 2000s. Right now, we have credit expansion through fiscal spending. That was the 7 trillion that Biden wants to spend. And we also have monetary expansion from the real estate market with the millennials coming into home buying years. So the credit mismatch to energy potentially getting squeezed here over the next few years, I think will be the driver of gold, because we have the same exact market conditions that existed every time gold did crazy things, just like the 1970s and just like the early to mid 2000s. And the valuations are so ridiculously undervalued for gold and silver mining companies and the physical metals, platinum and silver. I just see it as a huge opportunity as these market conditions replicate previous market conditions where these metals did very well under. Gold in Australian dollars now $3,300 per ounce, the highest ever. Australian MS Media. A former colleague manages a smallish family office and makes $1 million a year. I recently asked what they're invested in. His response: index funds, Amazon, Google, Netflix, Berkshire, and recently added Microsoft, Tesla, and Nvidia. Someone 7 figures just to see them buy these stocks when the S&P 500 or NASDAQ is an option. And that's what he's invested. That's what I think the majority of people are invested in. Everyone is piled into this. And eventually, when that all starts to rotate out, that's going to be when everybody has to come and basically sell those things. And when things go down, that's what causes pain, and that's what's going to cause everyone to sell. The thing that I think that will spark all of this will be oil. And that's why they released the strategic petroleum reserve, is to hold oil prices in check. If they lose control of oil, it's going to push interest rates up. And that's where the mismatch is going to occur. When interest rates go up, these guys are going to feel pressure. And it's coming. The pressures are in the system. It's just Powell's been able to hold it together with the SPR releases, with increasing rates real strong. He's doing a good job to hold it together, but this is just a matter of time now. Clock is ticking, in my opinion. And I like Calvin's response. I'm such an idiot for buying things like oil and gold because they historically went up in times of inflation. I should have bought tech stocks like everyone else. I just laugh because this is a true statement. Oil is the most inflation sensitive commodity. It's the number one commodity. It's the master commodity is what I call it. And when we get inflation, oil and gold and silver and platinum, those are the spots you want to be. But right now, it hasn't worked as well as tech stocks. Now, is that inflation being driven by the stimulus money? I think in the beginning, yes. But I think we're transitioning into a very large commodity bull market, which will be driven by shortages of oil, just like every other time in history. We're going to have fiscal spending up. We're going to have monetary spending be resilient. It's going to try to force those interest rates higher, and that's going to run into a oil supply shortage over the next, I don't know, it's probably going to start in 2024, and we'll probably see it in 2025. Here's Sahara on uranium. So this is URNM update here. Moving up the flagpole, though having a rest, it would seem. Watching those MAs here on the biweekly and see it as a Harame handle at the 12 moving average that needs confirming. Though the daily has obviously lost its 12, so that remains resolved until recovered. But this is a big flag pattern that's broken to the upside. He's got a couple of price objectives on this URNM. 42, we've got 74, we've got 98, and we've got 170 on the price projection. And this is an extension put upward from here upward. That's the 170, and then probably Fibonacci extensions is what he's used for 74. You can see this one is one of them too, the 74 there, and then 98 is probably a fib extension between the two. We're going to exit this winter with 632 billion cubic feet higher than the 5-year average. Not only did we not finish below 2 trillion cubic feet, but we are going to be near 2.3 trillion cubic feet. So demand for 2024 and 2023 this winter has not been good for natural gas. So we're probably going to stay lower for longer in the natural gas price, and you'll get your buying opportunities in a lot of these natural gas stocks. Silver's on the verge of a historic breakout. 2010 and 2020 breakouts resulted in a parabolic price action. Breakout could happen anytime, according to Rashid. And I know this guy's, he's been trying to put a lot of these projections always going on up. But I agree with him. It's a matter of time. We'll find out when that time is. But I'm not going to wait around. I'm going to be positioned in silver and gold and stuff. Today's February CPI release confirms that the disinflation trend ended months ago. Inflation has bottomed and is on the rise. Rather than falling back down to the Fed's 2% target, the rate is far more likely to head back up to 9%, then ultimately breaking into the double digits, is his opinion. So, do you think that inflation is going to go double digits again? I actually think it will. And it's going to be driven by, again, that credit mismatch against the supply of oil. Rick Rule states, in the 1970s, inflation went from being a topic of interest to being the primary economic concern in the country. I suspect that will happen in the United States in the next 5 years. Agreed. And that's the conditions that I keep describing. Short oil, credit expansion. This unprecedented Chinese gold rush will obliterate the Western paper markets very soon. China has been just eating up gold like no other. Gold demand is basically wiping out and putting everything into a shortage over in China. So they're going to continue to buy more gold and more assets, precious metals assets, I would assume, the entire silver, platinum, maybe even palladium too, and basically put the pressure on the paper market on the West. It's probably all by design. In the last hour, I project that the real-time natural gas storage surplus versus the 5-year average top greater than 650 billion cubic feet, the highest since 2016. Look for the surplus to stabilize just under 700 billion cubic feet over the next 7 to 10 days, but it won't be in a hurry to start narrowing back down. So it's going to take some time, guys. The gold counters in China were sold out in a single working day. Sooner or later, this will become global phenomenon. $20,000 gold is not a dream. It will become a reality. And how we get there and what his chart is showing us is we've got a channel here. So it's an upward channel moving on up. He basically took a couple of support resistance areas, put it right through the middle, and up at the upper end, it goes all the way up to 20,000 by maybe 2030. That's probably where we could potentially end up. I think we'll probably end up, yeah, I mean, that's a good likelihood, 10,000 ish, 8,000 ish dollars. But it could be 20 depending on the propensity for people to buy it. If we get the same type of, we'll call it herd mentality in Bitcoin into gold, I think we will go up there. And I think the technology stocks will suffer during that time frame. And that's where what's going to flow over. It's going to come from technology and crypto and back into gold and silver and these other ones. Lynn Alden says, this is what happens when public debt reaches well over 100% of GDP. Financial repression and currency debt devaluation versus scarcer assets. It happened in the 1940s and it is happening again. Nothing stops this train. And that's that inflation, aka financial repression and currency debt. It's got to devalue and they got to print more. And it's going to devalue the dollar against real things. And I think we have a combination of the 40s and 70s. It's a combination between the two because it's the 40s from the financial repression slash fiscal spending, that type of move. It's the 1970s because we've got an oil shock coming, but it's going to be worldwide, uh, not just the United States. Christine says, considering how 82% of new shale wells drilled simply replaced legacy production decline. So again, 82% of new shale wells drilled is just replacing production decline. February was the first month since 2020 that we didn't complete enough wells to maintain existing production. In my opinion, now is when the EIA production numbers will get interesting. So this is fracked wells count per month. We can see we're way down. Now, when I see this, we're going to see oil go up. Like, if we get production declines, oil will go up. We were going to get a shortage of oil. We're going to have to drill like mad to bring this all back into balance. I think the drillers are a spot to look. That's what I think. Here's UEC, another uranium update by Sahara. He says, recall, I was eyeballing this coil after it was attacking the breakout line after thinking it had plotted a truncated wave within. It has broken out and seems to be back testing the band. Yet we need to be mindful of a fake, so watching those moving averages. So this is Uranium Energy Corporation. You can see we hit this a couple of times, hit it again, and then we've broken out, and potentially this is just doing a retest before a monster move to the upside. He has some price projections. He's got $14.50, $50, 80, 190, and 230. And I'm sure they are projections of certain measurements and Fibonacci extensions that he's done on this UEC stock chart. Coming down to Brandon, he says, I think gold and silver miners are at prices where we'll look back 12 to 18 months and wonder why we didn't buy them hand over fist. We are talking 40% plus free cash flow yields with companies reducing debt, paying dividends, and buying back stock. Seems like a no-brainer in his opinion. Break wave, we've got freight futures, AM update, Capesize up 1%, Panamax up 3%, and tankers are up 1% on VLCC. Gold is doing a historical breakout right now. It's already done it. The big breakout level for silver using the yearly time frame is $31 to $32 an ounce, and not 38 to 50. That is on the lower time frames. The blue tightening arrow pattern means a breakout is coming. A 45-year very bullish pattern. Let that sink in. I just did an interview with Casper, and my comment is this the last best time to buy this stuff? I truly believe that this is the last best time to buy all of these metals. And Grady here says the mother of all very probable cup and handles. The bigger the base, the higher in space. The fractal and smaller cup and handle that is occurring. So the big one's this full thing, and then you have another one within it. The measured move target is 800% times 31, which equals $248. And again, you don't get to play this in your lifetime again. You have one chance to do it. The 1970s was the lead-in, and the cup and handle here is the pattern that we've got that is forming right now. And I think it will break out over the next couple of years, or even this year. We'll see. It could happen at any time. So I think this is the last best time to buy all this stuff. Gold versus the SPX. It says that is a pretty important back test for markets in many ways. Since big inflation usually starts with commodities, it shows that a second inflationary wave is coming. The chart also shows a historical sector rotation is incoming. Fantastic chart, really. And the sector rotation is when I talk about tech stocks going down and going into commodities. That's what I mean by that. He's saying the same thing I am. Gold versus SPY, gold versus stock market, 14-year falling wedge, a breakout and a back test with this ratio of gold versus the S&P 500. He says a line chart often shows what is happening before the candlestick chart does. There we go. This is intermediate crude. The risks is to the upside. Global oil inventories and oil on water in million barrels. Look at how low we are in relationship to the last 5 years. We are very low in inventory. And I'm very surprised at where oil is trading. People bearish housing. I regret to inform you that under the current Arthur Burns 2.0 Fed, prices are going up again, potentially a lot. Home prices can start going down when people are scared. They will go down. But we have a situation right now where mortgage rates are 6-7% and consumers have an expectation of 6% home price appreciation. So the mortgage is basically zero in real terms. And they are right. And here it is coming back up, and you can see it's close to the 2007 level. But this is your home price expectation, mean increase in home value during the next 5 years, about 3.5%. CPI inflation data is a few minutes away. Gasoline is up 30% since December into the news. This is gasoline. You can see a breakout here, which is 30% off its lows in the channel that it's breaking out of. And that's basically, I've got one quote here. Best in Wall Street. One, you have to think correctly. And secondly, you have to think independently. And that's where I'm going to end it, guys. So that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. And we'll catch you guys next time. This is Finding Value.